at all.
So it feels a lot like there's some good things that come when we slow down and think about things. When I think about my career, I've been trading options for over 20 years and helping clients with options. And when I think about options, I think about, there's two types of options. There's put options and there's call options. And the best way I've found to explain them to people is to think about there's a trade and there's a desk. And so in the old days in Wall Street, you went down with your certificates and you traded and you put them to people, meaning you sold them to people, or you called them from people and bought them from people. And so that's really what the put and the call are really about, is just the movement of the shares and the movement of future shares. And so an option gives you the right, not the obligation, to buy or sell either a put option or a call option. And so for people who own a lot of shares, they tend to sell call options to people that give them the right to buy their shares at a future price. So if we're talking about, let's say we're talking about NVIDIA and it's at 187, and you say, I like NVIDIA, but I don't think it's going to 250. So you might sell a call option, sell the ability for somebody to buy your shares at 250, 3, 6, or 9 months in the future. And then, as you imagine, the longer you do that sale, 3 months is worth $1, 2 months is worth $2. The longer it has to potentially occur, the more time value is what they call it, then the longer and the more valuable it is, because it gives the stock time to reach that new level from 187 to 250. So selling a call option is the most common form of using options. It's called option overwriting. It's taking your shares and overwriting options on top of it. And so what most people now are talking about is the market too high? Is the market too risky? Is the market something we should all sell it and go away? And in my experience, the big thing that causes people to make decisions is taxes. Taxes matter to people, because if you bought NVIDIA and it's up 1,200%, you owe a lot of taxes on it, right? And so whenever you sell some of those shares, you're going to pay maybe a quarter, a third, or even more to taxes. So you don't get to keep all of the money. And that's where people are very hesitant, because as they grow up and as they go through life, they see every day, every 2 weeks, hey, look at that money go away to taxes. I understand it's good for the country and it helps all things, but for individuals who are trying to attain a certain wealth so they can retire, that's really hard when they see that money go away. So what I've focused on a lot of my career is those people who are 5 years from retirement or in the first 5 years of retirement. Those people are most at risk, right? The market goes down 35, 40%, and you're 2 years from retirement. Your number that you were going to live off of has been affected, right? And so using options can be a way for you to kind of manage that risk. And that's where the second option, I'd say, we first talked about the call option and writing it. Now we're going to talk about buying a put option, which is buying the ability to sell at a price for a given amount of time. And so for that example, if we owned a ton of SPY, which is the index for the S&P, and we said, hey, I really don't think this can go down more than 15 or 20% before it will affect my retirement. Then I say to them, okay, we can sell it today and pay some taxes and then be locked in that market value, or we can buy put options. And these put options will allow you to stay invested And in case it goes down, the put option will increase in value by about the amount that the stock goes down. And that allows you to stay in the market, and it allows you to behave better. I mean, Marcus, I don't know how you feel about markets today, but when I look at it, I think it's really about behavior and not necessarily about the numbers. I mean, people are not used to, when they've had a certain amount of money and they face all of the news and events that are happening around the world. And I think that behavior is the thing that we're really managing. We're not only just managing stocks and money and bonds and cash. It's really about the client's behavior. And how do we encourage better behavior? Well, if you can take the emotion out of things and get them to focus on longer term, meaning I want to focus on 1 year, 2 years, 5 years down the road. You get people to focus on those things and not the short-term noise. That's a big asset for you because the investor is going to be patient. If he is patient, we know that the probabilities and the returns go up. So, for example, when I think of what's happening, I think about why do we get nervous? And we get nervous because we don't value a dollar going up the same as a dollar going down. We think the dollar going down affects us more. It could create an opportunity for you to buy, but that's really what we focus on when we think about money, is we focus on the downside versus the upside. We don't value them the same, as various psychologists, and Kahneman and Tversky did a lot of work on this and won the Nobel Prize for thinking about how do we value losses versus gains. And I think, Marcus, it comes down to how can we, as advisors, help people do better. And it may just be a conversation where you talk them through, do they really need the money now? What would happen? Would they take some of the stuff they have in bonds and move it over to stocks if they went down 30%? The answer would probably be, hey, it's on sale. It's on sale right before I need to make a last term decision, 2 or 3 years. I'm still working. I can live through 2 or 3 years or 5 years if I have to, because I know I'm getting good prices for the stocks, and I'm also positioning myself for 20, 30 more years than in retirement. I think everybody has thought about this retirement thing and said, oh, it's going to be a 10, 15 years. That's what my mother had or my father had. But in reality, we're all healthier. We've all been in a different health system. We all have these different tools to keep us living longer, not necessarily living better, but longer. And so therefore, I think that thinking about things around retirement is when there's a lot of risk and a lot of apprehension. And that's where tools like options can really be a plus.
Wow. Yeah, thanks. That was a good breakdown to especially for people who are real life situations, how they can apply it if they're about to retire or if they're close into retirement, how options really can help you out there. Just so just so folks know that on a simpler level, the call option, you correct me if I'm incorrect, call options usually meaning that you're bullish, meaning that you think that the stock's going to go up, like Mr. Stevens said. Put option usually means that you're thinking the stock's going to go down, so you're bearish. You were speaking about protection. I know a lot of things and you were speaking about long term. So, but I know in today's world, a lot of people are using 0-day traded options. That's a different thing. We're talking about investing versus trading for people. And if you want to learn more about investing versus trading, we have videos and other streams for that. We can go a little deeper in that on them. But the people also use options for income. Would that be something maybe someone could use closer to retirement? Can you maybe expand on that?
Sure. I think that's where if you have a big position in the SPY or an index fund, you can sell options for income. That's like the covered call where you say, okay, I'm willing to sell these things because I'm trying to lower my risk and I'm getting near a point in my life where I could use a little bit more income. So my S&P is paying me 1.5% and my bond fund is paying me 4%. So I know I should sell some, and this might be in a tax-free account your 401, an old 401k or IRA, and you sell a call option a little bit higher. And until it gets there, you just take that extra income. And so if you generate 2 or 3% from each option and you write them out 3 or 4 months, then you do that 3 or 4 times. Now all of a sudden you're taking in 5 or 6% income on those shares. That's a nice way to increase the yield and wait for it to get to a price that you'd feel good selling. And so when I think about options, they create, you guessed it, more options for you. And the idea is there's uncertainty in everything we do. There's uncertainty in the weather, there's uncertainty in health, there's uncertainty in everything. And so what you're doing is trying to profit from that uncertainty. And there are times when I look at an option and I say, the historical volatility of this is 18%. Now it's at 26, 27, 28. So it's paying 50% more than it normally pays because the option price is based on that volatility and uncertainty. So therefore, do I think it's 50% more likely that it's going to hit that price? No, I don't. I think that volatility bounces up and down around a mean. And what you should do is when things are priced in a rare way, meaning higher than normal, I think you should try to take advantage of it. When options are particularly low, I've seen them get down to 9, 10, 11%. And then I said, I think I should buy protection because the protection cost just got less by 50%. This happened after the recent Venezuelan move where we took and arrested the president there, Maduro. I don't think that arresting the president of Venezuela is necessarily a reason to think the market is less volatile. But that's what happened. So when the market gives you something, you have to ask yourself, it's given me this. Do I believe it? Do I think it's a good idea? And so I bought put options for a couple of the clients during that time. And it's really about trying to create the right feeling for our clients. Clients can feel very anxious about many different things in the world. And our job is to really help them understand the price of oil going up. What does it mean? The carriers going to the Middle East. What does it mean? All of these things are troubling to the average investor. And what we need to do is put perspective into their lives and the situation where we've been through this 3, 4, 10 times. And so therefore, help them to understand the things that are most important. If the market went down 20 or 30%, would your assets produce the same amount of income? Probably. So if they're living off that income, it's probably going to be fine. And then you say, okay, but let's say we get 4% income and 2 or 3% comes from the portfolio and 1 or 2 comes from selling something. Then we say, okay, we got our 2 or 3, that's going to be fine. But how do we make up for that 1 or 2% we need to sell? And that's what your bonds are for. And that's what your cash is for. So that when you need to go into something and sell it when the market is down, what happens when the market's down for stocks? Usually the market is up for bonds. So they'll usually appreciate 2 to 5%. So in that way, you're selling 2 to 3% or 2% to make up that difference to get to 4. And guess what? Bonds would usually be up, and they'll be a place that you can sell where you're not hurting yourself in terms of your long-term return estimates. Many people have planners like you, Marcus, and the planners look at them and say, hey, you're 60-40. We'd like to see you maybe be 70-30. That makes your average return equal to 7%. And that 7% is what you need to hit your target in 10 years. That's great. The question is, can you get the client to stay and meet that target? Or are they really a 50-50 person who doesn't like having that extra 20% exposed? And then you say, okay, let's think about this. How do we help the client take a little more risk so that they have a benefit in 3 to 5 years of a higher price and a higher market and a higher account value? The way to do that might be using options on that 20%. Hedge that 20% by buying a put option and selling a call option. It's called a cashless caller. And so you do that around the stock where you put 10% down on the put option and you sell the call 10% or more up. And then you say, okay, we can live with this in between here. If it goes up a lot, which we're not thinking it's going to because we're worried about the markets, I'd sell at 10% higher. That helps me with a 15% tax rate. I paid 2/3 of my taxes. If it goes down 10%, my put option gets more valuable and makes up for some of that decline. So it helps clients get through what I'll call difficult periods. And those are periods they're just not, they've never been in retirement. They don't know what it's going to feel like not to work anymore and have a paycheck every 2 weeks. And I think that what you're doing is you're creating some comfort for them around those numbers. And that's what I think, as much as we can talk about, if things go down, you're going to have this safety net from Social Security. You're going to have this much if you have a small pension. You're going to have this much from your assets in your IRA. Those things combine together to create a buffer for that person to get through tough times. And that's really what life is about. If you have a long time horizon, it's great. You can say, I'm long horizon. I don't need to worry about it. It's going to come back. Okay. But when you're 2 or 3 years from retirement, you don't have 5 years to wait. So therefore, this is a way to kind of create a little bit of safety net around that time when you're a little bit uncertain. And that's really what we're just trying to do, is get people to feel good enough that they can walk away and say, I'm focused on my life. I'm not focused on my portfolio. And that's really what we want to create, is that sense of peace. When I put my head on the pillow, am I worried about what my account is, or am I just worried about getting good rest? And that's what we really want for people.
Yes, sir. So yeah, the SWAN plan, sleep well at night plan. That's what you want for your clients. You mentioned a lot in there. You used the word protection in there. Protection, protection. So I guess one way of putting it would be if your portfolio was a house, options would be homeowners insurance. Would that be kind of, maybe something to that effect? You
Yep.
also in there you were saying to buy calls or sell calls, and obviously we're talking from a perspective of someone closer to retirement. And second, we're going to talk about someone who's like just getting started, because options can work for you at any stage in your investing career. Like I said earlier, you were talking about the protection, and then you were speaking about people who are closer to retirement and how they could generate these for income. They could sell calls, but you can't just own 20 or 50 of these stocks. You have to have at least 100. Yeah, can you break down like what exactly is an options contract for the people who don't understand it? It's 100 stocks makes that
Sure.
type of real quick.
I mean, one way for people to own stocks before they get started and they're, would be buying a call option. And so a call option represents the ability to sell or buy 100 shares. So each contract represents 100 shares. And so when you think about it, the S&P is somewhere around 650, and it represents 1/10 of a share of the S&P, and those shares will go up or down 1% in a day. So a 650 priced stock, 1% move would be $6.50. And so what I've put in place for people is the 620. The 620 put option is, about 6 or 7% down from where the market is now. I think that for younger investors, they might buy a call option that's a year or two out as a way to gain exposure without fully spending their money, right? They could say, hey, I'm nervous. I'm, say, 50-50, but I really know that I'm younger and I should probably take more risk. Well, why don't we take the risk by buying that call option? You don't have to put all your money into it. You put about 5 or 6%, which would be, say, $30, and you'd manage. So 30 times 100 would be 3,000 shares, and those 3,000 shares would be available for you to buy since you own the call option at some price in the future. And so in doing that, you get the upside, but all of your exposure is that 5% you put into the call option. So having that leverage to the upside for a young person allows them to still benefit on the upside, but the worst that can happen is the option expires and the stocks didn't go up. And then you've lost 5%. If you had invested the entire 3,000 times whatever the price of, let's say it's 6,500, that's 195,000. That's a lot different than putting 30,000 into something, right? So for that young person to be able to have exposure that's greater is a nice way. And so people will say, I really believe, my son really believed in NVIDIA because when he bought it 3 or 4 years ago, it was a great chip maker for gaming. And so he loved the NVIDIA processor in his gaming computer that he built himself. So when I said to him, do you want to buy AMD or do you want to buy NVIDIA? He said, I want to buy NVIDIA because it's the best. If I had to build a computer, I'd build it with NVIDIA chips. So therefore, I'm building my portfolio. I'm going to buy, and he bought, say, a couple of $1,000s worth of NVIDIA a while ago. It's up 1,200%. So he took his local knowledge about something and he put that towards, kind of like Peter Lynch used to say, know your stocks by following them and tracking them and being right on top of them. And if you're a consumer of chips because you work in the industry or you just happen to like gaming, you got to know NVIDIA pretty well. And then as they became the chip du jour and the whole AI thing, their value is just skyrocketing. And I think that local knowledge and young people's experiences should be a way to help them feel more comfortable. Because when NVIDIA was going down, he was looking at it and said, hey, I just tried to do another computer, and these NVIDIA chips are 30% more. Because I don't understand why the stock's going down. They're still the best chips, and they're getting more and more expensive. So how is this company not a good investment? That's the type of logic and experience you want to bring to the markets because he felt good about it as a company. Therefore, when you can feel good about something and know that you have a good asset, you can be more patient. And ultimately, that's what we're trying to encourage is patience and longer-term thinking. Marcus, you mentioned my background. I'm an advisor at Circuit Capital, and Circuit Capital uses individual stocks to help clients build good portfolios. We believe in balance, value, and quality. Those three attributes are what we try to fill our accounts with. We have a core account, a growth account, a value account, and something called faith-based. And faith-based is a strategy where we look at what the U.S. Catholic bishops say about stocks and which are socially responsible, and we buy a mixture of 40 of those stocks using Morningstar data to try to develop a good portfolio so that if somebody said, hey, I want to buy things that I believe in, that are linked to my principles and my values. That's why we created the faith-based portfolio. And I also, at Circuit Capital, am in charge of option strategies. So what we've tried to do is create a wide range of skills, my partner Travis Raish and myself, and bring that to clients at what we consider to be a really good value proposition. So I think that, Marcus, you've been on my podcast, The Skeptic's Guide to Investing. My partner, Clem Miller, and I both were CFA presidents at various societies, him in Baltimore and Washington, D.C., and me in Atlanta. And what we try to bring is the discipline that the CFA has to helping people understand investing and improve their overall financial wellness. If we can help individuals who listen to our podcast improve their financial IQ, we feel like there's a lack of really good information coming from the media. So we think that this is a good way to people to say, I'm a little skeptical. What should I think about this topic or that topic? And that's what we're called, Skeptic's Guide to Investing. And it really comes down to Marcus trying to help people through what I think is very hard, something that's we're not educated on as a society. And I know you belong to a financial literacy nonprofit. I did the same in Atlanta. It's difficult. What do you think about our financial literacy as a country and how we're doing things?
I think it's a sickness right now that we're going through. It's like an epidemic that we need to really work on curing, like spreading the message. That's part of the reason why we're doing this right here. Main Street meets Wall Street. We want to sit down and just take complex things like options and trading. We're going to talk about crypto, blockchain, the national debt. There's a lot of things that we're going to talk about, and we're just going to try to make them really simple for people to understand. Not because people are simple, but because these things aren't as complicated as people seem to make them. So that's definitely, one of my big passions. I want to. I want to ask you. So you being skeptical, and then you were talking about investing with options, and you used the example of your son and how he used NVIDIA chips. So let's say from the same time frame. So I'm assuming your son's coming out right at COVID 23, 24, somewhere around there, 22, 23, 24. Let's say you took the same person, not your son though, take another person same age who grew up going to Disney. They went to Disney this whole time. They said, I'm going to buy Disney calls. And they bought Disney calls at that same time. And we know where Disney stock was like $200 in. So it went the other way based on the same thesis. Like, what would you, I know, I mean, we know that you can't just invest on a company just because you like it. Like, there has to be different fundamentals in it. So, how would you like play that with the options besides, I
Uh,
guess,
well, the problem with, I mean, Disney in particular would have been a situation where I would have said, hey, if this COVID thing continues and we don't have any travel, less travel, the parks make up 40% or 50% of the revenue. I wouldn't say that's as simple a story as NVIDIA, where the chips that they're making, they can't make them fast enough for gaming. And then now that they've got into AI, they can't make them fast enough for the demand from AI. I'd say NVIDIA is a more of a technical powerhouse, and I'd say Disney is a recreational or a discretionary powerhouse. And
that's
so when we have situations like a shutdown, I thought that Disney went down from 200 to under 100, and my brother-in-law said, "Hey, I think it's really good. Should we buy some Disney?" I said, "After the correction, yes. I think that it's gotten beaten up, and I think we will eventually open up from COVID. But yeah, there is some discretion that I think you need to help people apply, which is put it in the right context, right? I mean, I think a person taking all of their account and buying a call option on Disney is never going to be the right choice. I think a person taking 2 to 3% and putting it in a call option on Disney, that's more of what I would call, it's sizing the opportunity. I think that you want people to have something that they can look at and help understand. It's a lot clearer to them when they look at Disney and they say, yeah, I went and I noticed that the park wasn't as full and as it usually is, and I noticed that the restaurants, there were no trouble getting reservations with, Minnie. Therefore, I feel like something's changed, and it has, because some of the demand for some of their services has gone down because people weren't traveling as much. And so I think everything, Marcus, is really about trying to find the right size, the right name, and the right situation to use individual stocks. I wouldn't say they're for everybody. I think a simpler choice is buy the index. It costs very little and it has great liquidity. and it's going to give you the exposure to the market that you should have. I think that what I'm trying to do sometimes with individual names is help understand the overall market. And, we added a couple of healthcare names this last year for my son's portfolio. He said, I don't know about all these. He had, out of his 15 positions, 12 were tech. And I said, this isn't really going to hold you up very well over the long haul. So why don't we try to do something where we mix in some healthcare, we mix in some, he didn't want to go with energy though. I couldn't get him to buy, fossil fuels. He doesn't believe that they're good, and I think that when we look at things in life, we want to find things, and health and healthcare were a much easier discussion, right? This pharmaceutical is going to be producing this drug that's going to be similar to Ozempic. Should we take a chance on Pfizer? It's selling at 8 times earnings. The whole market is at 23 times earnings. It pays a 3.5% dividend. I think this is something, if you're patient, this will be better in 3 to 5 years. So I agree with you that stocks represent risk and the call option can go to zero. But if you size it right, 1 or 2% of your portfolio, you can live with a 1 or 2% decline in terms of losing the value. That's where I think it can make some sense, and it can be helpful, because then the person can buy as many shares as they want when you get near the end of the expiration. And they might already have a gain, and that way, they buy it at 85, a call option on Disney, and it goes to 105. It's got $20 worth of value, and then they decide to, take the price they get it at, which would be, 95 or 85, and say, okay, I'm going to buy 20, 30, 50 shares of this, and I'm going to take the profit on the other options. And that way they've gotten in, they got to know it for a little while, and they feel comfortable with where they're positioned. I think it's really about gaining confidence in these markets. And I've started to have some worries about these markets. These markets have been a little bit different. And I think we all have to realize that with AI and with the different tools and things that are happening in the market, it's different. And how are we going to react to it and make people comfortable with it? That's really, I think, our job as much as it is understanding the investments.
Right. We help people with mindset and where they're at. Like you mentioned with the options, and you mentioned Peter Thiel earlier. I think I saw his quote where he was saying you only need to have if you can get 6 out of 10 stocks right, 6 out of 10 positions in your portfolio right all the time, you'll end up doing pretty well. But going back into that was a great explanation, by the way. With options, in my younger days, I traded some options before, right? And the thing that I found the hardest with options, and you mentioned timing, is when to get out, right? It seems like I always would be like, oh, this thing's gonna keep going. So how do you all over there at your firm time your options so people, or how can people plan on timing their options? You were mentioned earlier about the expiration date and people wanting to be out at the expiration date. You also mentioned later having earlier options that are 1 or 2 years out, so you have the time decay. Can you just elaborate on how you use timing, how you use decay, and just to see when you're pulling in and out of options?
So when options can go into the money, I always try to make my decision. Let's say I buy a 12-month option. I'll look at it as, as having 4 time periods of 3 months. So if it's a 12-month option, after 3 months, I'll look at the position and say, is it in the money? Is it significantly in the money? If it is, then I've had 25% decay in time and I'm in the money. I'm going to sell 25% because 25% has gone and I've got a profit on that 25%. And it'd be great if I had enough profit that all of the other options have been paid for. And so that when I sell, I'm basically taking back my original investment. The best way to not lose money, as Buffett says, rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
Yeah,
I
sell when you're up.
believe we all should look at ourselves and say, hey, I'm a quarter of the way through this. It has gone up. Therefore, it's time for me to open the cash register and take some profit. And then we get to 6 months. I ask the same question. Are we in the money? How much are we in the money? And if we are, let's sell another quarter or the 25% or a third of what's left. And so you can look at it as the original money and look at the original return. But yeah, you see some time decay, which is natural. And then you also see volatility. Maybe volatility has kicked up. And so instead of it being the amount that it's in the money, it's because the market is more volatile. And that volatility is another driver of price. And so, while the first one was just going up because the market was good and the price was good, the second time you look at it at 6 months, it could be the volatility is much higher. October and September are two of the most volatile months. You could be going through those months and have higher volatility. And so you sell a second amount at that point. Then at the 3 month point, you could be sitting there and it's below where you want it to be. It's below your strike price. And you could say, it's all over. I haven't, you've already paid for this option. You probably paid and gotten a return because you sold some in the first quarter and the second quarter. So in the third quarter, when you have still, 3 months to go, I think you got to leave it alone and say, this has already been paid for. I'm going to do this. I might buy the stock. It still could give me, if it goes up $5 or $6, it could give me a little cushion to buy this stock and have a lower purchase price. That means I paid less for it. So I'd say, hold on. You don't always have to sell because your goals have been met. You've gotten exposure to it. It's paid off for you. And you still might want to buy some shares that you want to make a part of your portfolio permanently. And then one day before the end, you're going to make a decision on those, half of the position. And you say, okay, what am I going to do with this? And it's going to be pretty clear. Either you're in the money, a good deal, and you say, hey, I want to own all these shares, or you say, I like it, but after this passing of 12 months, I don't feel as good about the company as I did before. In which case, you might just sell for whatever profit you have and then move on to another stock or another idea. I think you want to try to find ideas that are longer lasting. So when I look at some of the names, in my son's thing, the Microsoft, he doesn't like Apple. He's a Samsung guy. So it's really important that you find things that you say, this company 5 years later still got good prospects, still a good thing to own. And that's where you really find quality stays true and does well. And I think that quality names like a Microsoft or an Amazon or some of the names, I really find they're great companies. And one thing we did in the at Circa is we write a monthly blog. And in the blog one time, I looked at companies that contribute the most to their communities, meaning what do they do in terms of charitable activities? And Microsoft had some number, I think it was like 40 billion of activity in the community. Up in Washington, they're reconverting rail cars for homeless people. They offer nonprofits around them and around the country free materials, free software, free items to help them run their nonprofit. I think that when you look at companies, it's great if they have a great balance sheet and a great income statement. But the other thing we look at, especially for our faith-based investors, is are they good companies? Are they working with the community? Are they doing the right things to make our society better? I think it's very difficult to do A and B, good balance sheet and good profit statement. I'd say, hey, you guys do that well, and you do that better than your competition, and you do that better than a lot of other people. You deserve a lot of credit. But if you can also do that well in terms of how you treat your employees, how you treat your community, that to me is a home run, right? That's not a double. It's your company is doing things right for the consumer and their client, but they're also doing right by their employee and their community. I think that's really about the mentality of a stakeholder versus a shareholder. We want to satisfy shareholders, but it's really great if you can satisfy stakeholders, because then you've got people in the nonprofit community who are thankful for them. You've got people in their direct community who see the good work of their rail cars and other things. That's really what I would call success. We measure it different ways, Marcus, but ultimately, I think that's the way we should start to think about it more often.
Perfect. Yeah. And as you and like you mentioned, you just mentioned a lot of different things that people inside of investing. So some people, you said you look at how much companies contribute to society. And that is definitely a theme some people invest in. Like you said with your son, he didn't want to invest in fossil fuels. That's also a theme that people choose to invest in or not invest in. Some people choose to invest in tobacco or not in tobacco, right? That's one thing, but it's not the same thing as when you see people who choose to invest because we have a Democrat or Republican in the office. Never do that. That's a good way to lose money if you choose to invest based on politics. If you want to invest based on something else, like Mr. Stephen was stating there, that's a different story. But overall, history shows that whoever's in the office, red or blue, it turns green over time. The stock market goes up and to the right. Um, just wanted to make sure people understood that point. Well, one more thing with options that I really want to kind of dig into your funds. Can you just like break down? So I know this isn't what you do. I know we're talking about investing, but like a huge thing that's happening now, like we live in this world where people are just worried about speed and everything has to be so fast. Could you maybe elaborate on the explosion of 0 day options? I know that boosted a lot with the year of the retail investor last year. So,
Sure. I think with the meme stocks, we had a lot of people who realized that owning GameStop was one way they could make a statement against the hedge funds who were shorting it. But they realized very quickly, what do options have in them? It's leverage. And so if I can pay for an option 5% of the price of the stock and buy that option, if I can do it for one day, my leverage is 20 times the return. So therefore, on a 1% return around an earnings announcement, or 2%, or sometimes we see 8, 9%, that multiplied times 20 is an unbelievable way to make money. But the other side of that is, it's a normal distribution. And when you think about normality, there's a big tail there on the left that's negative. And so minus 100 is what you have on the left tail if the stock stays where it is, meaning it doesn't go up. At the end of that 1 day period, it doesn't go up, you lose 100%. On the other side, if it does go up 2%, 3%, you get a 20% return, or 40% return, 1 or 2%. So I think that these options are really speculation. They're not investing. What an investor is somebody who believes in something and will stay with it. In my mind, it never makes sense to take short-term profits when you can wait and take a long-term, right? Long-term capital gains, somewhere around 20, 15 to 20, and then short-term, it could be 40, 45, even higher in states like California and Massachusetts. So
yeah, the
therefore, you
taxes.
say, how do we justify wanting to speculate versus invest? I'd say the difference comes to first, I only look at things that I want to hold for a year. That's what I do when I buy stocks. If I do something shorter than that, I look at it as a speculation versus an investment. You need to let things go through time so that you're more efficient in a taxable account. Again, if we're in a non-taxable account, in an IRA or something like that, a 401k, you can do other things because there isn't that tax drag that you would have in a normal taxable account. Taxable accounts require patience, and patience pays off in that, when these names keep going up every year, you're paying on, a little bit of tax on the 1.5% dividend. So 20% of 1% is zero point 0.2. That's not a big drag. If you sell and pay short-term gains of 40%, that's a drag. To take away 40% of the profit you generated versus waiting till a year and getting it at 20%, that to me is a significant enough drag that you want to avoid. So I guess I would say, Marcus, some of the things that are happening in the market, one-day options, SPACs, some of the things going on with AI companies buying other AI companies, capital investment, it looks and feels like it's a little bit frothy and a little bit overpriced. So I would say try to be long term, try to be only with companies that you really believe in and have good prospects, and then try to do a good job of watching out for your taxes. Don't let them rule the decision, but just try to be, if you try to take 1 year as a time frame in a taxable account, I think that's a reasonable time to expect to wait to get a good result.
Yes, it's a big difference in investing and trading. I'm glad you broke that down a little bit better for them as well. And then another thing, I know you have and kind of some of these 0-day option traders have the same mentality as the poly market, where you see these people trade with those like maybe the same type of mentality. And that's definitely not an investment if you're jumping in there.
Yeah, I
Yeah,
mean, I hate what's happened to sports. I mean, because to me now, every NBA game I watch, they want to tell me about, what person's going to score in a quarter, what's, how many rebounds is this guy going to get, and how many, I don't want to make everything a prop bet. Life isn't a prop bet. Life is, taking a holistic view for longer periods of time. Like, we're not individually looking at ourselves saying, ooh, if I pull down a 3% return on this stock today, I'm a winner. No, you don't measure winning and losing on one day's performance. You measure winning and losing longer term. How have I behaved as a person? How was I as a husband, a son, a brother, a father? Those are the things that you try to measure success at. And I look at these as kind of like we are all looking for that short-term gratification. The average attention span has gone from 16 seconds in 2023 to about 9 seconds today. 9 seconds. So if you don't pick something up in the 9 seconds and communicate quickly in the world of X or the world of Insta, it's kind of like we're setting shorter and shorter time frames, and yet we know that financial success requires a delayed gratification, and that delaying of gratification gets harder and harder when we expect results. And hey, I want to put this prop bet on while I'm still in the casino and I can see the result before I leave. Well, okay, that's taking the amount of things you can invest in and gamble in, and saying, okay, I also want to put it on a constraint that I'm going to find out in the next 10 minutes. I think that what we're all trying to do is find the way in the financial sense of our life. Use our human capital to create results that are going to benefit me and those I love over the long term. People coming out of college with debt and no assets, they look around and they say, I'm poor. I look at it and say, you have a college degree, so you're going to earn more than a high school diploma, and you're going to ultimately have a lower chance of unemployment. Therefore, when I take your 40-year career and I discount it back to the present, you're worth about $4 to $5 million. You don't see that. It's in your human capital. But when we look at things in the right perspective, and the guy from the University of Chicago who did this in the 70s, he was looking at countries and how they invested in the education of their people. The higher countries with more education per capita, guess what? They had the more GDP per capita. It was a straight correlation, and that's why countries dedicated resources towards education of their people. Now you look at it and you say, hey, in 2000, people used to talk about the value of a company goes up and down in the elevators. And I'd say, yeah, there's human capital there that manages funds, and we need that human capital. Now, I want people to take the next step, which is let's look at every person as a combination of human capital and financial assets. How do we combine them together? You know, if a person goes back and spends $5,000 on a certificate, a CFP or something else, their value is going to be higher. They're going to have those letters next to them, and they're going to be able to say, I'm worth more. I think that all of us are working on that. And I think it's really important that we don't take a view of you are the balance sheet that you have right now. I'm going to add up all your assets, your car and that's not your value. Your value is much greater because you've invested in yourself and you have a degree and therefore you have a prospect. Why do you think the car companies want to give you that lease? Why do you think the credit card companies want to give you those cards? Because they know you're going to be able to pay for them. They see who's graduated from college and they send those people immediate credit. I think that what we're trying to do, Marcus, in this industry is really increase the overall value. That's the human capital and the financial assets so that people can realize their full potential. And I think it's a little bit different. Like I said, the stakeholder mentality versus the shareholder mentality. But I think what I've noticed, Marcus, is people are starting to understand more. I agree that the average, person exposed to financial information is low and is a bad situation. But I think we're getting there. I think now they just said that 64% of high schoolers will have some type of financial literacy class by the time they graduate. When I started in 2015, it was 14%. So the national 401k or, program that they came out with last year. I mean, should we have done that in the 70s and 80s? Absolutely. Why does it take pensions going away 40 or 50 years ago, and we're right now saying the whole population can have access to a 401k? I think we should have probably come up with it before 2025. But all we can do is today going forward, and all I'd say to people is take advantage of a 401k, take advantage of these things that the government's creating, because in the long run, the more tools and the more access you have to information and ability, the more you're likely to succeed and build out your financial wellness.
Good. Yeah. Yeah, that was a lot. And I know you used a lot of great terms there. Like we've spoken on like stakeholders and shareholders, right? The stakeholder as the person who's like in the community or the person working at the job, someone who's not exactly owning the stock. That's your stakeholder. Getting benefits from the community, people who are getting, like you said, with the type of things Microsoft and other companies do versus shareholders who are just, in general, people thinking they're just looking for their returns and their profits, people who actually own the stock, the shareholders. And you can actually be both, right? You can be a shareholder and a stakeholder. And then this just whole lack of literacy inside the country and the world, I know that's something that we talked about offline and online as well, just how the world is moving towards working towards helping the world learn more about financial literacy, but we still have such a great gap to go. It leads me right to where I want to go next. Just tell us a little bit more about so you mentioned back in 2015, and tell the world a little bit more about you, like how you got into this and then how you got to where you are today.
Well, in 2008, I suffered cancer. I had throat cancer during a time of a lot of volatility and stress. And I was trying to tell our chief investment officer to buy puts in July of 2007. And he said, no, it's too risky. Not enough people would understand and didn't want to do it. And I said, now is the time to do it. Now is the time to differentiate ourselves. And, if we bought the first option, it would have returned 1,300%. Or 13, so instead of our clients losing 36, they would have lost 23, which is a lot of outperformance in 1 year. And in my experience with that, I looked at myself and I said, I don't know what the right thing to do is I have cancer. I'm worried. I know that it's a very curable cancer. It's got an 80% cure rate, but I didn't like that 20%. So when I looked at it, I said, look, hey, if I get through this, I've been a pretty good father and husband and brother. I want to really be more for the community. And so that's when I got through it, I started mentoring college students in finance and investments. And I went from mentoring to being the president of the society in Atlanta. And then when I was president, I decided that we had a lot of assets on our balance sheet. And I said, these assets aren't helping anyone. Why don't we take 100,000 of them and put it towards financial literacy? And so we built up, and now I think for the last 10 years, we've given somewhere in the order of 300,000 away. We still have 300,000 on the balance sheet. And we've probably impacted with our financial literacy videos almost 1 million people. And
Wow.
so those things that you think about when you start them, 10 or 11 years ago, you don't know what it's going to become. And right now we've got a great program with the Boy Scouts and Girl Scouts. Boy Scouts and Girl Scouts usually come from, Title I schools. They usually come from economically needy areas. Those kids now are learning their financial and entrepreneurial badges, and they're starting to understand, with the help of the Atlanta Fed, more about what's available to them. What can you become? And one of the things I love about the Boy Scouts is they say to the student, you need to ask the person how they came to their career, and you need to help understand whether that career might be something you want to think about. And I just think it's a great opportunity for people to get up and look at the community and say, we would love to have these high school students who are young enough to pick a career in finance, when they graduate from high school, having that experience of talking to another CFA who was an Eagle Scout and hey, I went through the badges. This one was the hardest for me. What's the hard, helping people to see their future is, in my mind, worth so much. Because if you can see your future and you can see the pathway, you can make it happen. And I think that what we're trying to do with the financial literacy in Atlanta is to, one, open up the eyes of the people in the community, two, go out to the whole community. I'll tell you one quick story. When I set up these videos, we have 12 videos on 12 main ideas that we think help people be financially, start adulting. And when we think about adulting, we think about savings and investing and all of this stuff. But one of the things is we have a video of 3 minutes that's budgeting. And so ASFIP Foundation is on YouTube page, and we have it in both English and Spanish. When we look at the budgeting app, one of the people we focused on was Athens zip codes and Atlanta zip codes. And when we looked at Athens, we got this response once on Facebook from a minister of a small group from Ethiopia. And he said, I've been in this country 3 years, and I think that this video helps me and all of the people in my congregation to learn how to budget is a key to life. And so I looked at his following of almost 500 people, and they were all members of that Ethiopian parish. And I look at that and say, we pushed that video out with $100 investment to Facebook, and it got about 8,000 views. Well, one of those 8,000 views was this preacher and pastor from Ethiopia, and he shared it with his 500 congregants. I look at that and say, I don't know how many people we affected. I don't know how many lives got changed, but I think it was an opportunity where good things could come. And that's what we need to do as a society, is keep making those investments where good things can come.
Yeah, that's really cool story. Like just that pond and the ripple effect, and you just never know who you're impacting. Like and once again, like part of what we're doing here. I'm so glad that you hopped on with me, and so we could just talk about this kind of stuff and give this information to people who might not ever hear it and never receive it. Like the world hears things and sees things from the media or however it is. Like you mentioned in 2000 and we said 2007, 2008, there were other people who saw what was happening in the market and was like, we should short this, right? But the people who had the voice or the table and were on TV or weren't exactly those people, and they were spreading a different message, right? So it's like
Right.
access is so important, and when you can take access and you can take something like this and put it in a package like your 12 videos, and you can just spread it out to the masses. You never know who's going to get. You never know how it's going to help someone. It's just really good
Well,
things.
you know it's good information, and you know it's well structured, and you know it's done from a sense of caring. Like I said, the way we started as a foundation was we said, if we could tell our children in an hour what the most important things were there for them to do in terms of finances, what 12 things would we tell them? And that's how we came up with our list. We said credit cards, managing your credit score. We said, managing your investments in terms of asset classes and risk, and thinking about, fraud. Fraud is, really hard on that bottom 50%. The average person has in their account something like $500. And guess what the average amount of fraud is? $500. So it's, we know where it's happening, we know why it's happening, but we've got to do more to prevent it. And that's what, you know, I love what you do, Marcus. I love the way you talk to people. I love the way, you're doing with ABC Squared. I think that what you want to do with people is the right choice. And that is leading with planning and giving people an opportunity to have different outcomes. And I hope I can do whatever I can do to help you. And I've enjoyed our partnership over the last year, even if it all just started because we were both wearing, Jordans at the conference, and we both had the same taste in sneakers. So you never know where something will lead.
Yeah, that was. Thank you. Yeah, you never know, and I don't know if that says like you have the style more of a middle aged black man, or I have the style more of a middle aged white man. I don't know what it's at, or maybe we just both grew up watching
I think
Jordan,
you're
and we like
lower
that.
middle. I think I'm upper middle.
It's all the middle. We'll just call it all middle age. How about that? We'll just
All
keep it all
right.
in that range,
I
right?
like that.
But yeah, no, that's very cool and it's very true. Everything that you just said, especially your shoes, like that was the thing we noticed. Everyone else had on like the square shoes, hard bottoms. We had on suits and our Jordans, which is cool. I want you to, I want to respect your time. I want you to take some time and just talk about your funds, the funds that you're putting out to people, and how, if anyone wanted to invest in these funds, right? Let's say I had, or how much someone would need to just like, could I just pick up the phone, call you, and say I want to invest in your fund? How does that work for Main Street?
So we offer separately managed accounts at Circuit Capital. You can find us on the web at circap.com, circap.com. We're an advisor based in North Carolina, Georgia, Massachusetts, and we have other clients in Texas and Colorado. But our main thing is offering these strategies of active. We usually try to get clients, of different sizes, but I think if somebody wanted to invest, I think somewhere around 75 or 100,000 would be about where we would probably be able to create a nice complete portfolio with all the weights and all the names. We like to buy 40 names in our faith-based portfolio. In our dividend portfolio called Global Dividend, it's 50% US, 50% international, and it has a yield of almost 4%. That portfolio has 50 names, but really what we want to try to do is to create names that people feel comfortable owning. So when COVID happened, my partner, I said, how many calls did you get from people in that month of March of 2020? He said, none. I said, how can that be? He says, I've been talking to people all along in the monthly blog about here's why we invest in these names. And our clients sent me an email and said, I'm so glad I'm invested in Costco. I went there last weekend and they were doing a great job of giving me resources I needed to get through COVID. And when you see companies doing the right thing for their community, when you see companies giving you value, and I've eaten as many hot dogs as the next guy for $1.50, it's hard for me to walk by and not buy it. I can't help myself. I love value. I'm a kind of a cheap Yankee. I guess the word is frugal. But I'm, I look at things and I try to identify value in my life, and we try to do that in our stocks. And it's not going to be the high flyers. We are not going to be 100%, equal to or greater than the return of the market. The markets get away from average pretty quickly, and then they revert back. And what we're trying to do is stay with higher quality so that when it goes down, we don't go down as much. When it recovers, we recover more because we have higher quality names that people follow. And that's what we're trying to do. We're not trying to guarantee performance. We're not guaranteeing anything. We're trying to buy names that you can believe in. And by believe in, I mean be patient with, own for the long haul, and try to realize that, hey, U.S. equities operating around the world create some great companies. And those great companies, if they're in your portfolio, you can feel good owning them. That's what we want. We don't want to say we have the highest returns. We don't want to say we're going to beat the benchmark. We want to say we're going to give you a good risk-adjusted return. And I think that's the difference, Marcus, that a lot of people kind of forget about. Risk matters. Risk makes people nervous. Risk makes people behave badly at the wrong time. They sell out at the bottom. They don't hold when they should hold, and they don't sell a little bit at the top because they think more and more is coming. We want people to be balanced, and balance and quality and value are the things we emphasize at Circuit Cap, and we think it's going to be a good place for most investors. And most of all, we just want to talk to people and try to get them on the right path. And ultimately, getting started is a big part of this, right, Marcus? I mean, people are smart, people are very capable, but it's hard with all the things you got. Hey, I got this weekend, I got this T-ball game, I got this, there's a lot of things happening. I got Easter Sunday is at my house, so I'm going to have everybody over. I don't have time to look at this. And I understand it's difficult. Being diligent and being successful takes effort, and it really takes discipline. And finding that discipline through better ideas is what we try to do. If you can look at our webpage and look at some of our blogs and see how we talk about money, I think that's what I would ask is check us out. And if you like what you see and you think that this is a way you want to invest, give us a call or send us an email because we would love to help you.
Excellent. Yeah, and I'll definitely put some links in the description where people can get in touch with you. Maybe some links to those financial literacy tools if you like as well, where people can check them out. Some of the
Sure.
videos you made. I know you inside that comment you mentioned your global strategy, which is dividends, and then your faith-based strategy, which is based on the Catholic diocese around the U.S. What are the other two funds?
So we have a core strategy that's 40 names and is based against the S&P. That's the longest strategy. It's got over 11 years worth of history. We also have a growth strategy that has about 5 years of history and a value strategy that has about 4. Both of those strategies are specific for certain times when people say, I feel the market is too high. We put people into a value strategy where they can feel a little safer, or a dividend strategy. And then we might migrate some of the assets and have half dividend, half growth, or half dividend, half core. And that way they can kind of think about what their needs are. And again, the dividend strategy is really for people who are closer to retirement and want more income. And the value strategy is really more of a, hey, these names have been just beaten up and not given any credit. And now I looked at it, for the first 5 weeks of 26, we're up about 6%. So that's the type of strategy you wouldn't think would be up that much. But this market has started to turn and is offering different things to different people. So these are all, all these ideas are given to you from a sense of educational. We're not guaranteeing performance. We're not guaranteeing any results. We're just trying to give people an educational understanding of how it might be best to structure their portfolios and have many different ways to try to win in the markets.
Gotcha. Yeah, and that's also like say, and that's a big part of it too that people don't realize. Like if you're concerned solely with returns, you sorry financial advisory industry, you can go buy an S&P 500 index and pay a small percentage off of it and kind of catch what the market's catching, right? But what we help people with is we help people with like making sure they have their assets in proper allocations, like you said, for your tax implications for when you're later in life. And we help a lot with the psychology because people, we say it all the time that you should buy low and sell high, but people do the complete opposite when panic happens. They sell low and they buy high. So just being able to go in and help people to remember their why, like you said with Travis, how people weren't calling him in 2020, y'all are constantly communicating information to people. Like communication is a big part of it. Information is a big part of it. So what y'all do is a really good thing. And the funds that when you say they're equal weighted, for those who don't understand, that just means he takes the 40 funds and divide them all equally into the out of 100. So, and you just get your percentages out of them. Some may be a little bit higher, some may be a little bit lower, but that's pretty much what he means with equal weighted. And then, yeah, man, this has been a really good conversation. I guess if unless there's just anything else you want to leave the world with Main Street, you want to tell them something while we're here.
I guess I would say that, always protect and enhance your human capital. I think individuals, who the number one source of bankruptcy for individuals is a healthcare expense. So something happens that you don't expect and your costs, and it causes bankruptcy. When you think about your life, your health, your education, and your mental well-being are all part of helping you be the best person you can be. Start there and then start investing. But when you build with your core, meaning your mental well-being and your health through exercise, diet, and and learning, I think what you're doing is investing in yourself. And those are always the best investments. You are the best investment you can make. And so take care of yourself and then work on learning and understanding how to invest with guys like Marcus and our podcast. I think there are good people out there who are trying to help. And my thing is to people, first help yourself, then look to others who can help you. And that's the way I would probably end it.
Excellent. Yeah, I think that was a great point, Mr. Steven. I really appreciate you hopping on with me. I think we had a pretty fascinating, wide range of conversation for those who check it out. Like I said, I don't know if one person or a million people will hear this, whatever in between. Hopefully they find some value in this. If you do, please check out Mr. Steven. Check out his podcast. If you find value in this particular episode, you can hit like, subscribe, whatever it is you're doing, whatever platform you listen to. Share this with people so people can have more information about how Main Street meets Wall Street. We're going to have other experts coming on to just have conversations about these type of things. We're going to have people talking about the national debt. We're going to have people talking about cryptocurrencies, blockchain, things that people hear about and they think are just really overwhelming topics for them. We're going to try to break them down as simple as possible. So if anyone listening has any questions that they want answered, send them to me or, reach out to Mr. Steven. Let them know where they can find you, Mr. Steven, or it'd be a good place to reach out to you.
On www.circap.com, CIRCAP.com.
There you go. And you can find him on LinkedIn. I know he's on LinkedIn as well. We're connected on LinkedIn. And yeah, I guess that's just another way that Main Street meets Wall Street. I think that was a great conversation, Mr. Steven, and we'll talk to you.
Thank you, Marcus. I think you do a great job. I appreciate you.
Thank you. Thanks, Main Street. We'll talk to you next time.
All right.